Good morning, everybody. Thank you for joining us today. We're going to give everybody a few minutes to join, and then we'll get started. Thank you. Okay, so we'll get started. Good morning, everybody, and thank you for joining us for today's special event. I'm Brian Gamble, Senior Vice President in First Long Island Investors. First and foremost, we hope everyone continues to be healthy and doing well. Before we get started, I'll cover a few quick logistical items. All participants are currently in listen-only mode. We will also have time for questions and answers from the group at the end. Please feel free to submit them as long as we go along by using the Q&A dialog box. I will now hand it over to Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, to introduce our speaker today.
Thank you, Brian, and thank everyone for joining this morning, and good morning. Normally, we'd be having a breakfast seminar this time of year, but out of COVID caution, we're continuing with Zoom. Hopefully, at some point in the not too distant future, we'll be able to join you for breakfast. As you all know, after several strong years of performance, we find ourselves in a very different and difficult investment environment thus far in 2022. The causes now are fairly obvious: hyperinflation, particularly gasoline at the pump, food, Fed rate increases, including yesterday's 75 basis point increase, Fed about to deleverage its large balance sheet, the remnants of COVID, including supply chain disruption, the unfortunate and uncalled for Russian invasion of the Ukraine, Washington, D.C. policies as we approach midterm elections, and fear of recession. On the other side of the coin, we have very strong employment and we have growing S&P earnings. But there is a formidable wall of worry that we're dealing with at this point. To give us perspective, we have as our guest this morning a dear friend and colleague of First Long Island, Bob DeLucia. Bob was formerly senior economist and portfolio manager for Prudential Retirement. Prior to that role, he spent 25 years at CIGNA Investment Management and 15 years with Prudential Retirement, most recently serving as chief economist and senior portfolio manager. He currently serves as a consulting economist for Empower. Bob has 50 years of investment experience, and he is a very close colleague of ours at First Long Island and has been very helpful to us over many years. And we are confident that this morning he will give you some interesting perspective on how we approach this investment environment as investors. And Bob, it's my pleasure to turn it over to you and introduce you once again. I think this is the second time that you've joined us with our clients and colleagues over the last 15 years. So it's all yours.
Thank you so much, Bob. Thank you for that very kind introduction. It really is a pleasure for me to be here. And Bob's right. We've worked together for many, many years. And it's been it's been one of the highlights of my career to work closely with First Long Island investors. My mission today, as I see it, is to try to shed light on the great uncertainty that we're faced with. And you, as clients, should not feel concerned if you're confused, because I don't know anybody who isn't confused and bewildered by what's going on. Even the pros that I talk to on a regular basis are very much concerned and bewildered by what is going on now and how that's likely to turn out. So conditions are changing very rapidly. To say we're in a state of flux is a gross understatement. In fact, I've got a chart package here and with bullet points and economic graphs. Some of those are actually outdated, and I produced this report within the last few days. So it just goes to show how fast things are going. So what I'd like to do is begin, before getting into the real meat of my presentation that's in this presentation package. I'd like to begin with a 3-minute summary, kind of a capsule summary, to lay the foundation for where I'm going with my views on the outlook. The first point I would make is that the economy is in far better health than is generally recognized by the markets and by investors. There are still numerous growth drivers in the economy: consumer, capital goods, business, consumer services. And most importantly, when you think about a recession and what the likelihood is of a recession, the first thing you look at is are there imbalances? Are there excesses? Are there distortions in the economy? And there really aren't. Obviously, inflation is an imbalance, but if you look at the usual factors that are of concern, debt levels are at very reasonable levels. Credit quality is good. Balance sheets are in excellent condition. We haven't overbuilt housing. We haven't overbuilt capital goods. And the only area where there is some excess is in inventories. Inventories are higher than they should be, and that means the production is going to have to slow for a few months in order to get those inventories under control. But other than that, the preconditions for a recession are not in place. So I believe that a recession is not imminent and is not likely to occur until 2024. However, because of yesterday, there is a caveat to that. And and that is that the Federal Reserve could very well decide, as they appear to be indicating, they could decide that they want to get the rate cycle over with as soon as possible. They understand how far they are behind the curve, the inflation curve. So 75 basis point increase yesterday, as Bob indicated, was more than they had previously signaled. They were previously signaling a half a point increase in the Fed funds rate. They moved it up 3/4 of a point and likely to raise the Fed funds rate again, another 3/4 of a percentage at the July meeting that occurs July 27th, and then no meeting in August. Next meeting would be in September. Who knows? So that's a caveat. I mean, that's a caution that, and I'm not waffling, because I don't know what the Fed's going to do. Nobody knows what the Fed's going to do. All I can say is the classic preconditions for recession are not in place. But the Fed, if they move aggressively, very aggressively, they could induce a recession, and maybe even intentionally, in order to get inflation back down to where they want it to be. So what does that mean for the bond market? Bonds are still in a bear market as far as I'm concerned. And I think bond yields are going to go much higher. The 10-year Treasury is at approximately 3.35 today. That could easily go into the 4s, maybe even 5. And that really depends on a number of factors. In the meantime, I think we could get a relief rally with interest rates moving lower and bond prices moving higher. That would be a counter trend or counter cyclical move in the bond market, because I think the basic trend, the cyclical trend, is for higher yields and lower prices. With respect to the equity market, it's been painful, of course. Market is now down 23.5% from its peak earlier in the year. And further declines are probably likely. Although I would say that, based on the analysis that I've done with respect to valuation measures mostly, but also economic conditions and the earnings outlook, I think we're mainly through the suffering in terms of the bear market. Could we go down another 3 to 5%? Yes, absolutely, and we probably will. But I think as far as the bear market is concerned, I think we're probably in the 8th inning, and getting very close to the point where we can start thinking about a stock market bottom. Finally, the best news for long-term investors like me and you is that, number one, the market is at a good entry point. The PE on the S&P 500 is 16, which is way down from where it was, and reasonable relative to bond yields. But even more important than that, in terms of stock selection, we have the opportunity to buy the best companies in America, in fact, the best companies in the world, that have been dealt with harshly by the market. And I'll talk about this more later, but this is not unusual that this happens, that the most desirable, the most attractive companies tend to hold up for a while in the bear market, and then at the very end, when investors really lose hope, they begin to sell everything. So we're seeing significant declines in many of the best companies in America, and that gives long-term investors an opportunity to put away in their portfolios some really, really excellent companies at reasonable valuations. Okay, that's my summary. So let me, we've got the first page up here. Let me summarize drill down a little bit deeper on some factors in the economy. So I've already mentioned that the classic preconditions for recession are not evident, and I expect to see the economy to continue to expand through 2023. I'm not looking for a rapid growth rate. I mean, the rapid growth phase of the cycle is behind us. As you recall, we grew at 6%, a couple of quarters, 5%. Those days are over as we get later in the cycle. But I can see growth, GDP growth of 2.5% for the next number of quarters. And just for reference, that would be above the growth potential of the economy, the underlying long-term trend, which is estimated by the Federal Reserve at 1.8%. I think it's closer to 2 in my own view, but we're still at 2.5% would be growing above that. So that's a positive. I'm very bullish on business capital investment, capital formation. If you turn, there's a chart in here. Brian, it's chart number, it's slide number 7, chart number 3. And you can see that, you know, we're in a new world. This is the best measure of a predictor of capital goods spending, capital investment. And you can see new orders for non-defense capital goods have broken out. The last big cycle we had was in the 1990s. That was driven by technology, the internet, fiber optics, all that. You can see that back in 90, 97, 98, 99. This is a powerful backdrop right now for capital spending. And if you think about it, it's pretty obvious. Profits are up, balance sheets of corporations are in very good shape. Labor is scarce, so businesses are really keen to invest in labor saving equipment for automation. The infrastructure bill will begin to kick in next year. It was passed last year, but we all knew it was going to take a year to get started. The big years for infrastructure spending, the $1 trillion bill, the bipartisan bill passed by Congress, will be 2023 and 2024. Another underlying factor, which I think is critical, is the rebuilding of supply chains. And we're hearing it from companies from A to Z that they are bringing their supply chains closer to home, manufacturing closer to home. It's especially happening in the automotive industry and in the semiconductor industry. Tens of billions of dollars of plans. In the case of semiconductors, it's actually 100 billion in plans to build plant and equipment inside the United States. And that's going to be a real boost for the capital goods market. So that's a real positive factor. There are 2 other factors I'll just mention to complete the picture. Investment in farm equipment is going to be very strong given the dire outlook for food around the world, partially resulting from the obviously the war in Ukraine and what's happening there. And the other thing it's obvious again, is big investment in energy. I mean, we're going to be in a multi-year cycle where investments in energy, both fossil fuels and alternative, are going to be quite strong. So capital investing is a big factor in the outlook. With respect to consumer spending, if you turn to the next chart, which is chart 4, slide number 8, you can see that consumer spending on durables have been very, very strong. In fact, they're above trend and are likely to weaken. Meanwhile, consumer spending on consumer services have lagged. And as we reopen the economy, as people get out and mobility increases and begin to travel and spend money on recreation and so on, consumer services is going to grow very, very rapidly. And remember, consumer durables is only about 15% of consumer spending. Consumer durables, consumer services represent close to 60% of consumer spending. So that's going to be a driving force going forward. Consumer balance sheets are in great shape. Wages are growing at a rapid pace. And this has been well publicized by many analysts that households still have about $2 trillion of excess savings on their balance sheet that came about because of the generous COVID relief packages that were legislated by Congress, and also to some extent, by deferred spending that occurred during the periods of lockdown. So there's lots of buying power, spending power on the sidelines, and that should allow consumer spending to grow. It's not going to grow at a rapid pace, but it'll grow at 2 or 3%. And at 70% of the economy, consumer spending should be a good provide a good boost to spending. The next bullet point has to do with company earnings, and admittedly, company earnings have become a legitimate concern. I don't think we're going to get a decline in earnings. In fact, revenues are growing pretty rapidly. Revenues are growing at about 10%. So when we get second quarter earnings reports, which will begin about a month from now and go into August, we're going to see that revenues are growing at 10%. The question is, what happens to profit margins? A lot of pressures on margins from wages, from supply chain issues. Obviously, raw materials are up a lot. So I think it's going to be a mixed bag. I think profits can grow in the quarter, about 5% this quarter, and maybe 5 to 10% in the next 2 quarters, the third quarter and fourth quarter. But I can't pound the table on that with a great deal of certainty, just because there's so many risks in the outlook. But I say this with some confidence. It is going to be a mixed bag. And again, I think the best companies in the world that dominate their markets, have pricing power, have organic growth opportunities, strong balance sheets, and cash flow. I believe they're going to be able to grow their earnings at a very respectable clip. Disappointments, I think, will come among the weaker companies, maybe the smaller companies. I think that's what we have to look forward to. Inflation, a big question, a big concern, obviously. The thing I want to point out with respect to inflation is that I have a chart here on inflation. Brian, I'm looking at slide number 13, and it's chart number 9. So you can see here, the point I want to make here is that, and I'm not trying to massage the numbers in any way and make them look more favorable, but part of the negativity in the market among investors is that there's, I think, considerable misunderstanding about what the inflation rate is. Every day, whether it's a politician or whether it's a portfolio manager or whether it's somebody in the media, they quote the inflation rate as 8.6%. And it is 8.6% year over year. But there are a number of problems with that consumer price number. First of all, the consumer price index is not a particularly effective way of measuring inflation. It has a number of problems with it. The Federal Reserve uses what's called the core consumer deflator as their measure. So when they say they want inflation back down to 2 or 2.5%, that's what they're talking about. Over time, and this is over a long period of time, if you look at the numbers, the CPI, the Consumer Price Index, tends to exceed the underlying trend and the consumer deflator by about 0.5%. Another problem with the 8.6 number for the consumer price index is that it's a year over year measure. The problem with year over year is it's too long a period, and you have base effects which can affect the current. What I want to know is what's the run rate? What's the current run rate? And we can debate whether that's the 3-month inflation number annualized or whether it's the 6-month, but typically those are pretty much about the same. And when you break it down, when you take out food and energy, and I understand those are big problems, but when you're trying to gauge the future, they're so volatile that you really want to exclude those so you can really perceive what the underlying trend is. When you make all those adjustments, inflation, I would say, if somebody asked me, what's the real inflation rate? I would say it's 5% right now. Now, is that good? No, it's a terrible number. But it's a lot better than the numbers that show up in the media and that what many people focus on, which is the 8.6%. So what's my forecast? I think inflation, and many people believe this, that inflation is going to trend lower over the next 6 to 12 months. We are going to get some relief. But just like the surge in inflation was transitory, in my opinion, the disinflationary period, the counter trend, is also transitory. So maybe we get inflation, the consumer inflation number, the 8.6 number, maybe we get that down to 3 or 4% temporarily, but it's not going to stay there. It's going to go back up again once we get into the later stages of the cycle. Inflation is a lagging indicator, so it tends to lag the economy. It tends to lag policy. So I think we're going to see inflation in the 4 to 5% range for a while until we get the next recession. I don't think the Fed can bring down inflation, or the government or private sector, in the absence of a recession. I mean, I think we really need demand destruction, a decline in spending and demand, in order to get the inflation rate to go sustainably lower than it is right now. The Fed, the next bullet point is the Fed rate tightening cycle, and I want to refer you to the next. It's not the next slide, Brian. It's the one after that. I'm sorry. It's a table. Well, let me get it here. It's table. There you go. Now, up until yesterday, I was feeling pretty good about this. This is pretty incredible. People are worried about a recession. I mean, they have been worried about a recession since the Fed started raising rates in March. That was the beginning of the rate tightening cycle, when they went from 0 to 0.5%. They raised the funds rate 0.5%. But look at how long it has taken in previous cycles. Even the inflationary period of the 1970s, the Fed began to tighten in January of 1977. We didn't get the recession until February of 1980. That was 37 months. So on average, it's been 2.5 years or more from the time that the Fed begins to raise rates that we get a recession. Now, yesterday changes things. I mean, I'm a creature of history. I believe that history is important to consider. But if the Fed really slams on the brakes and really is determined to crush inflation because they understand how far they are behind the curve, then we could get a break in this pattern. Now, let me say something just to put this in perspective. As a general rule, in order for the Fed policy to restrict the economy, let me put it this way, to begin to impact economic activity so that you see GDP starting to roll over, it takes at least 12 months, in some cases 12 to 18 months. Now, that's different than saying we go into recession, because what I'm talking about there is that the growth rate in the economy goes from 3% to say 1.5%. 2.5 years, it'll go to zero or negative. So if I want to make sure I'm precise and well understood on that point. The conclusion it leads to is the Fed did 75 basis points yesterday. They could do another 75% in July and maybe another 50 or 75 in September. That would not begin to filter through the economy until the middle of next year or even later. So I'm sticking with my conclusion that I have had for some time, that a recession is not imminent, but it could be more imminent than would be suggested by the history of the past 75 years that shows up here on the chart. So let's drill down on that a little bit. If you go to the next chart, actually, this is very instructive, because here's the theme. The theme is that the economy has never gone into a recession until policy rates rise above zero on a real inflation-adjusted basis. In other words, to put it simply, the Fed in the past has had to raise the Fed funds rate above the inflation rate. Well, you can see where they are now. I'm showing 1.5% there. It's really 1.75%. So you can make that adjustment for the Fed funds rate for the blue line. And to be consistent, you can see for the inflation rate, I'm not using the 8.6%. I'm using what I think is the underlying rate of inflation, which I believe is in the 5% range. Well, either way, the conclusion is the Fed has a long way to go in order to get the funds rate above the inflation rate. Now, I did say the inflation rate is likely to come down, but it's not going to come down a lot. If we're lucky, over the next 6 to 9 months, 12 months, maybe we get it down to 3.5. So that means the Fed has to raise the funds rate to at least 4% in order to create a real Fed funds rate that's above zero. Now, at yesterday's meeting, Chairman Powell, Jerome Powell, indicated, and I'm not sure why he necessarily did this. I thought it was somewhat precarious on his part, but he did say where he thought the Fed funds rate would be at the end of this year and the end of next year. He said it would be at 3.5% at the end of this year and 4% at the end of next year. I have no problem with those numbers. I mean, I think that's could happen. In fact, the federal funds rate could go even higher, if the economy is resistant enough, and if inflation is not coming down the way the Fed would like it to come down. So this is a very, very important chart. If you look back to 2018, 19, you can see for that brief period of time, the Fed funds rate did get above the inflation rate. And what happened was we had a growth slowdown, a significant slowdown. It was a soft landing, but growth went from like 4% to 1.5%. And so it worked for the Fed. There weren't excesses at the time, so we didn't go into recession. I think that's what we're looking at here is for steady rises in the Fed funds rate. And it's kind of a race between the Fed raising rates and inflation coming down to see how high, in fact, interest rates have to go. So before we go to the markets, I'm going to conclude by saying, anticipating a question that people may have. And so what should we look at? What, as investors, what should we be monitoring in order to try to gauge where the economy is going? Well, the first thing is the yield curve. The yield curve is the best predictor of a recession. And it just so happens that the yield curve is still very steeply sloped. When correctly measured, I'll say that again, when correctly measured. Many analysts use the spread between the 10-year and the 2-year. That's a good measure, but it's not the best measure. The best measure is the 10-year versus the 3-month Treasury bill. And just to get some credibility on that, the Conference Board has as many of you know, a series of 10 indicators that make up their leading economic index. One of those is, as it should be, the yield curve. Well, guess which one they use? The difference between the 10-year and the 3-month Treasury bill. That's in chart number 2, Brian. So it's slide number 6, and you can see it there. The spread actually is about 175 basis points. That's a pretty wide spread. Now, I understand the spread between the 10-year and the 2-year is only 15 basis points, but this measure that you see here is the best measure for signaling a recession. So we've got a ways to go before we get a convergence between the 10-year and short-term rates in order to create an inverted yield curve. So that's one thing I'm watching is the yield curve. Also watching inflation, obviously. I'm watching housing starts. We had a decline today, about a 10% decline. The problem with that was they revised April's number much higher to be the highest 1.8 million housing starts in April, which was the highest in like 15 years. Housing is proving to be resilient. It's going to weaken. It has to weaken. But the question is, how much does it weaken? Because that's the very front end of the economy. It's the sector of the economy that the Fed targets most in determining how rapidly they have to go in terms of tightening. Other indicators, real personal income, the monthly purchasing manager survey, very important, both in terms of manufacturing and services, and capital goods orders, which are quite strong. If those were to weaken, that would be a red flag for the economy. So those are the things I'm looking at with respect to the economy and how to gauge the timing of the next recession. Okay, we can turn to slide number 3, which is financial markets. I'm wondering, Bob, does it make sense to pause here and see if there are questions that people have?
Sure, we can. I've got a few that I'll throw out to you, Bob. maybe to stimulate other questions, and then we can go on. That was a very interesting discussion that you brought to us, and it highlights the complexity of the environment that we're in and the shifting tides that are occurring very rapidly, including the somewhat unexpected 75 basis point increase yesterday. But one thing that I heard you say, which resonates with me in a positive way, is that we know we have this excess inflation, which is not new, by the way. It started about a year ago with the price of oil going up rather dramatically from $50 to $60 a barrel to almost $100 a barrel prior to the Russian invasion of the Ukraine. So we're concerned about that and the impact on the consumer, which is a 70% of the economy. But you suggested that the consumer, due to the pandemic and the generosity of the federal government, and Larry Summers, who's a Democrat economist, would suggest there was too much generosity coming from Washington, D.C. at the end of the worst part of COVID. But you've suggested that the consumer balance sheet still has $2 trillion of excess funds, which would actually help the consumer during this period of time of increased inflation. So I wouldn't, unless you disagree, I wouldn't knock the consumer out so quickly, given that excess cushion that they have. And at the same time, you pointed out with a very interesting slide that business investment, non-defense, is breaking out. And that will be aided by infrastructure over the next few years. So between the consumer, and listen, you can't get an airplane flight, you can't get into Disney World, you can't get into a restaurant. Some of our colleagues, we own a Visa as a company in several of our strategies. And one of our outside colleagues had a meeting with the CFO of Visa. Of course, he would not give specific information, but he led our colleague to believe that spending, at least from the Visa credit card network, is very robust. So it's obvious that consumers are spending and businesses spending. Do you view that as benefits to putting off the recession, even if the Fed is somewhat aggressive in trying to bring down inflation?
Yes, I do, Bob. I would agree with that. And I would add, not only Visa, which of course is a terrific company, but also the large banks that have very large consumer businesses, Bank of America in particular, JP Morgan, Wells Fargo. Their message has been that consumer spending is strong. I mean, they see it in their credit cards, they see it in their consumer lending, that consumer is spending. Now, that can't last forever, particularly if oil prices stay high. But we're seeing oil prices come down. It's hard to say whether that's sustainable or not. It probably isn't. I think oil prices are going to stay higher for a while because of just the very tight supply situation. But one of the, you didn't mention, I don't think, Bob, one of the key things is employment.
It was just about to ask you about that. How do you have a recession with 3.6% unemployment?
Yeah, right, exactly. And adding 300,000, 400,000 payroll jobs to business staffs. And that's going to slow. I mean, it's not going to stay at 300 or 400. It was at 500, 600, 700 for a while. Now we're heading lower. But still, every indicator that you look at shows that the demand for labor is very, very strong. And as you suggest, we even have a shortage situation. So, so the excesses aren't there that you really have to look closely at to determine whether or not, or how vulnerable the economy is to a recession. And as I said, except for inventories, which are high, and we heard that big time from Walmart and Target and others, and we can also see it in the macroeconomic data. Other than that, the economy looks pretty resilient at this point.
You know, Bob, one of the consultants to us at First Long Island is a friend. He's also a client who is in the marketing business and is a consultant to the major retailers, that some of which you were just referencing. And he suggested that because of the supply chain disruption during COVID, many companies over-ordered just to try and get the goods that they needed. And as the supply chain situation has abated slightly, somewhat, some of these companies end up now with over inventory or excess inventory, which has to be marked down, as was evidenced by the announcement by Target, I believe, last week. So, to some extent, the inventory situation you're mentioning was unintended, but it's there. And I guess you suggested that production has to slow a bit to permit those inventories to be digested. Do you see, or do you hear evidence of the supply disruptions starting to recede, such that we can get, I mean, that's part of the inflationary problem, is that freight costs have gone up dramatically. I know of a company where they import a lot from the Far East, and a container went from $3,000 or $4,000 coming from China to over $20,000 a container. And now it's down to $9,000 a container, which is yet to be filtered through the system. But the fact is that the cost of freight from the Far East is coming down. Do you see any hope in terms of supply chain getting better and that helping to reduce inflation, besides the Fed on its mission?
I think, Bob, that the trend is favorable. That we are seeing evidence that supply chains are loosening. We're hearing it from companies, but we're also seeing it from the data, as you mentioned. Container rates have come down quite a bit. The number of tankers that are parked outside of Los Angeles, Long Beach, has come down quite a bit. And I'm not sure these are the exact numbers, but at the peak, there were close to 100 maybe sitting offshore. And now we're down to 60 or 65 or something like that. But freight rates have come down. One of the reasons the purchasing manager surveys are so important is because they do have a component that tracks delivery times. And delivery times hit a very high level in terms of it's kind of inverse. When it goes up, that means delivery times are being strained. That number is coming down. It's not collapsing, but it is trending in the right direction. So I think things are going to improve. We'll continue to improve, but at a slow pace. The one area that's not going to improve immediately, is going to remain tight, is the market for computer chips, semiconductors. It takes about 2.5 years to put up a $20 billion facility. And by the way, as I said earlier, many of those are coming in the United States, down in Arizona. Intel announced a $20 billion plan in Columbus, Ohio. But if you look at the timing, when they were announced, when they were started, those aren't going to become available until a year from now, and even later. I mean, the first batch of supply would be sometime in the middle of next year, and then through the end of the year, and then in 2024. So chips are going to be in short supply. But other items seem to be clearing up somewhat better. The final comment I'll make is, of course, and you mentioned China. China's a wild card because we don't know the path of COVID infections on the mainland. And Shanghai seems to be out of the woods, and that's the biggest commercial area, manufacturing area, but now it's spreading Beijing and other areas. So it's a wait and see situation in China to see how that is that's how that's going.
But without stealing your thunder from more discussion and conclusions, It sounds to me as an investor, like everyone else on this call, that patience is a virtue as all of these things seem to work out, that ultimately inflation will come down to a more reasonable level. We've got to give the Fed a chance to give us the castor oil. Those of us who are old enough to know what that is, okay, that sort of medicine to this inflation that we actually induced to a large extent through the Fed policy and through fiscal policy in Washington, D.C., whether it was restraining fossil fuel production or it was being overly generous during COVID, going beyond, as Larry Summers suggested, what was needed at the end when there was an extra $1.5 trillion or $2 trillion injected into the system. So we've had this adjustment in stock prices. Valuations came into the year on a somewhat high basis, which we've suggested in our quarterly letters and our thought piece. And as you once suggested at a seminar years ago, the key to investing long-term is your entry point. So it's pretty obvious that we've got a much better entry point right now. But I'll let you continue and then we can talk about conclusions later on. I don't want to get ahead of you.
Okay. No, that's very helpful, Bob. Thank you. And to your point about inflation, before I move on, you're right. We will get inflation under control eventually. And the bond market, the futures markets is indicating just that. I mean, if you look at the TIPS market, the market is, it depends on which measure you use, but the measure right now for 5-year inflation is either 2.5% or 3%, depending upon the measure you use. So again, investors are putting their money where their mouth is, that they don't seem to be, well, these bond investors don't seem to be spooked by these 7-8% numbers that get thrown about. But the key question on inflation is, can we get it under control without a recession? We can definitely get it under control with a recession. And we saw that in the early 1980s when we had a severe recession, and inflation, I think it surprised so many people, but inflation went from 14% or so, 15, down to in 1982, 83, 84, it got down to 3.5%, which was a pretty significant drop at that time. So, well, let me move on to I mean, I think there's a great deal of interest in the equity market and the bond market. With respect to the equity market, let me begin by saying that I think it's helpful if I describe the current equity market in the context of that is, say, the bear market we're in now, in the context of the bull market that we experienced in 2020 and 2021. My view is that what we're seeing now in this bear market is an unwinding of the speculative excesses that were built in 2020 and 2021 in financial markets. I think what we're looking at is a mirror image. So in other words, you can look at 20 and 21 and see what happened and how things unfolded. And you should expect just the opposite, a mirror image of that as we go through the rest of this year. As I say, I believe, and I hope, but I also believe that most of the damage is done, that most of the losses are behind us, that we're in the 8th inning, but I think we still have further to go. What do I mean by mirror image and unwinding? The bull market that we experienced in 20 and 21 was very much speculative driven. Tremendous amount of froth built up. And it's not surprising. Anytime, as Bob described, the generosity of the government, both the Federal Reserve and the Congress, in pouring trillions of dollars of liquidity, the stock market was very much, the bull market was very much a liquidity driven market. And what liquidity does is it does a couple of things. It accentuates excesses in valuation, but it also leads to excessive risk aversion. Risk taking, risk appetite. And you can see that in many, many instances. You can see it in the NASDAQ to a certain extent, but I'd be more specific and say those stocks in the technology sector that had no earnings. They were valued as on a ratio to sales. Well, those stocks are down 75, 80% today, and they should be. Where else do we see speculation? The concept of work at home, stay at home, COVID, stocks, whether it be Peloton or Zoom or AMC or Roku and Robinhood, you know the group. I mean, again, those are down 70, 75%. That was purely speculative driven. Valuations got to ridiculous levels. Those stocks, as I said, are down 75%. Where else did we see it? The IPO market. There were 1,500 IPOs that came to market, initial public offerings, during the past 2.5 years. Many of those companies aren't going to make it. I mean, they weren't prepared for interest rates as high as they're going to be over the next year or two. The junk bond market, the yield to maturity on the Bloomberg index, the bond index, got down to 3.5% at its low. 3.5%. Now we're closer to 8.5%, 9%, which much more attractive. But that just goes to show reaching for yield by taking risk was pervasive in the period of 2020 to 2021. I could go on. I'd be remiss if I didn't mention cryptocurrencies, Bitcoin, which is down whatever, 60, 65%. And also the SPAC market, special purpose acquisition companies, individuals writing blank checks for companies to make acquisitions. Pretty darn risky. I think we're on the, well, I don't think. We are on the other side of that right now. And what we're seeing is, again, the mirror image, much more conservatism. Liquidity is not driving stocks. It's going to be driven by earnings, by fundamentals. A greater risk aversion means embracing the best companies in an industry, the best companies in the market. So I think this is what we're seeing, this unwinding, and I think it's going to persist for a little while longer, but I think we're pretty close to a bottom. There are a number of indicators that signal that. I mean, sentiment is at very, very low levels. One of the indicators that I look at very closely is the put-call ratio, and that recently rose to a level comfortably above 1.0, which is very, very definitely in gloom and doom territory. And for contrarians, that's a good sign, a good buy signal. So that's the market that we're in. And I think once you understand that, I think it makes it a little bit easier to plan an investment strategy going forward. And we can talk about that as I get through that, but I wanted to lay that foundation before. While we're talking about that, I probably should, if you go back, Brian, I'm going to refer you to chart 14, which is slide 19, way in the back. It's the second last. And you can see what happened. This is truly amazing. This is mutual fund and investment flows, equity mutual fund flows. It also includes ETFs. Well, look at what's happening in the late teens, 2017, 18, 19. We were running about $4 or $5 billion a month of inflows. Look what happened in 2020. It almost quadrupled to 25 billion pace. That's starting to come down. Last month, I believe the month of May, was the biggest withdrawal on record for equity funds and also for technology. It is unwinding, and one of the risks is we don't know how much unwinding has to take place. Markets always overshoot on both the upside and the downside. So whereas I think we're at fair value right now for the S&P and other indexes, the risk is that we go beyond fair value and go to deep undervalued, and that would take the market down another 5% or so. The next slide, Brian, shows a chart that I watch very, very closely. And you can see the very close correlation between earnings. That's an index of earnings that I've created. Earnings per share, this is the S&P 500 earnings, and the actual index. Well, you can see how they tracked very closely. The market was undervalued right after the Great Recession. You can see that 2011, 12, 13. And then after the Trump election, more confidence in the economic business outlook, the market got overvalued again a little bit. And now you can see what happened from 2020 to 2021, a huge gap between where the market was. It peaked at 4,800. You can see the peak in the blue chart. And it's down now to roughly 3,800, a little bit less. Meanwhile, earnings continue to grow. So we're close to where we should be. In fact, if I drew that line back down to 3,800 on the S&P, we'd probably be below the earnings per share. So valuation has improved, but you could see how out of kilter it was back in 2020 and 2021. Okay, we can go back to slide number 3, Brian, which is the summary of financial markets. Bullet point number 3, shifting to bonds, because I think bonds are going to drive stocks. I believe interest rates are going higher, 2024, 2020, late next year, 2024. But I think that we may be in a peaking process right now where we may get a relief rally, that we have overshot on the upside in bond yields. I think markets have overreacted. So I think a pause where rates stabilize perhaps around 3% for a while would be very positive. I would not play that as an investor because it's unsustainable. But I would play the equity market, because if we get bond yields lower, bond prices higher, I think that would spill over to the equity market. And my 4th bullet point, which is very interesting, for many, many, many years, probably beginning in 1995 through 2020, 2021, there was a negative correlation between the stock and the bond markets. So stock prices would go up, bond prices would go down. Now we're in just the opposite. We've returned to positive correlation, and it's very positive. It's about 0.5, 0.6 correlation between stocks and bonds. So if bond prices are going to go up, as I think they could over a period of time here, the next 6 to 9 months, stock prices should also go up. Not only would stocks benefit from higher PE ratios, but the earnings I believe, are going to continue to grow, even though they're growing at a pretty moderate rate of 5%, 5 to 8%, that sort of thing. Where does that leave us in terms of the market, the equity market? I think we can recover the majority of our losses, maybe not all losses, by year end. So that would be a pretty solid rally from here. And if we don't get a recession until 2023, later the second half of 2023 or 2024, stocks could go to all-time highs. Why do I say that? Is because stocks, and we have a chart here. It's I think it's at the very end, Brian. It's a table slide 18. You can see that in general, going way back, that stocks generally, I mean, the common wisdom is that stocks peak, the equity market peaks 3 to 6 months before a recession. And you can see that played out here, except in a couple of instances. If you look at February 1980, it was coincident. So the market peaked and the recession began. What happened then? Very simple. The recession was unexpected because what happened was Jimmy Carter, afraid of inflation, too much credit, slapped on credit controls to the economy, and widely misunderstood. I mean, consumers were so confused by that, many just put their credit cards away because they thought they couldn't use credit. And the economy fell abruptly into recession. So that was 1980. 1990, in August of 1990, Saddam Hussein invaded Kuwait. That was in August. And the recession began in August. Nobody knew that Iraq was going to invade Kuwait, but they did. And that's what happened. February 2020, again, I mean, who predicted the pandemic? So the recession occurred a month. The market peaked only a month before the recession began in March of last year. So what's the point of this? Well, again, based on history, I mean, markets should reach a peak somewhere close to the peak in the economy prior to the recession. And I don't see that for quite a while. So that gives us a pretty good runway for stocks to move higher over the next, over a 12-month period. Now, it's going to be very choppy. It's going to be very volatile. And the reason I think it's going to be so, because of the uncertainty in general, uncertainty surrounding earnings, surrounding inflation, surrounding Russia and Ukraine, you name it, energy prices. But I think the greatest uncertainty is what the Fed is going to do. And if they move quickly, is that a good thing or a bad thing? On certain days, people will think, yeah, it's a good thing because they're bolstering their credibility and they're addressing the inflation problem so we get it out of the way sooner. So that's a good thing. Other days, people are going to think, yeah, it might be good long term, but in the short term, we run the risk of crunching the economy. So stocks go down. So I think we're going to be in that very volatile pattern. But I think from here, as a generalization, looking out over the next 6 to 9 to 12 months, I think the trend is going to be higher. I think that the final point, that I would make, Brian, we can go back to the page 3, which was the conclusions. I'll save value stocks until the end. That's the third bullet point from the bottom. Favored sectors: industrials, financial, energy, and technology. Technology stocks have really been hit hard to the point where they're, in my opinion, based on the work that I do, really significantly oversold, particularly the creme de la creme companies. I'm talking about Amazon, who's been crushed, down 45%. Google, Apple down 30%. Microsoft down 30%. So those are the favored sectors. Lagging sectors have been where the market has been over the last number of months. They've been looking for safety. They've been looking to be defensive. And the utilities have done very well. Consumer staples have done well, healthcare. But once we get a different narrative on the economy, that a recession is is likely to be pushed off into the future, I would expect that these stocks would be lagging stocks and could be sources of cash. Finally, and then we can really want to get to your questions. Growth versus value. I've been a value supporter for a long time. Value has done really well. If you look at the Russell indexes over the past 12 months or so, certainly this year, significantly outperforming growth. I guess we're at a point where I don't feel as strongly about that right now. I don't feel as strongly about value. One of the reasons is that so many of the magnificent growth companies that were selling at 35 times earnings 6 months ago are now selling at 20 to 25 times earnings. And there are terrific companies in that area. Bob mentioned Visa earlier. That's come down. American Express has come down. Stryker, the medical device company, has come down pretty hard. Great company with a terrific long-term growth outlook. Danaher, another healthcare company with high-tech test and measurements, and most of their revenues are repeat business. Just a terrific company selling in the 30s. Now it's selling at valuations of 23, 24 times earnings. So those are the stocks that I would look at. I had mentioned Nike, which is down 45%. Again, a solid growth company. So there's a lot to choose from in the growth category. I would suggest, and I know Bob likes to use the term barbell. I'm going to say make up a term, a triple barbell, because I want to separate techs. So I would have growth stocks that I mentioned. I would have the high tech stocks that I mentioned, and then I would have cyclical quote / value stocks. And there's some terrific companies that have come down or really at great entry points. I'll mention UPS, which looks very, very attractive. Illinois Tool Works is a terrific capital goods company. Fastenal has come down. John Deere looks very attractive in terms of cyclical stocks. So let me stop there. I think I've covered a lot of ground, and hopefully there are questions that from the audience.
Bob, thank you so much. Before I turn it over to Brian to field questions from our visitors today, our clients and friends of the firm, I want to point out that Bob and I did not script the names of the companies that he just mentioned. I would say 95% of which we own in our different strategies. That was not scripted. It was not pre-planned. We just view quality through the same lens, let's say. And with that, Brian, I will ask you to field some questions for Bob.
Okay, thank you very much for sharing all of this with our participants. We'll now begin the Q&A session from our audience, and we've already gotten some great questions already. Please continue to send in your questions, and we'll get through as many as we can. So, all right, first question, Bob, going back to the Fed. Has the Fed lost credibility in your view, or has your opinion changed in the last 24 hours, given what's transpired?
Well, they've definitely lost credibility to an extraordinary degree. They blew it on the inflation call. They were too late to start. They should have been tightening months and months and months ago. As far as regaining credibility, I think they've regained a little bit, but I don't think they can regain the credibility that they lost in one meeting. I think it's going to take a few meetings. And it's a really good question that was asked, because credibility is so important for the markets. So I think Jay Powell understands that. And I think that's why he pivoted so dramatically and is on a track, apparently, to really aggressively tighten. So we got a ways to go, but they're moving in the right direction.
Thank you. Next question. We talked about the preconditions for a recession, that classic preconditions for a recession that are not currently present. But looking forward, if inflation remains elevated, even if it peaks soon and affects consumer confidence and spending, might businesses cut down on capital spending and continue to announce layoffs, resulting in a possible recession? Kind of just lead it, a precursor to what we might see.
Yeah. I mean, that zeroes right in on one of the key intangibles for economists to try to deal with, and that's confidence. It's just so hard to know what's going to break confidence in the business sector. Confidence is down, and you see that in a lot of the surveys, but they can continue to indicate that they want to spend. And there's a need to spend. That's the important thing. And I guess the other important thing is that they have the wherewithal to spend. Balance sheets are in terrific shape. For those of you who find that perhaps hard to believe, look at there's a bar chart, and I believe it's chart 7, slide number 11, and you can see this is interest coverage ratio. It's actually not coverage. It's the inverse of coverage. So what this shows is interest expense, net interest expense for business corporations, non-financial corporations, as a percent of cash flow. Look at how low it is right now. I mean, it's never been this low. We're about 10%. Now, I'll make a very important point in terms of the imbalances and things we would worry about, and I'll finish my answer to the question. Don't worry. But both one of the either lucky things or one of the good things that happened is that businesses and households were really alert to taking advantage of record low interest rates to refinance and to lock in very low rates. 80% or more, 80 to 90% of mortgage commitments, mortgage liabilities, 30-year mortgages are locked in, as opposed to being floating or variable or whatever. On the business side, businesses raised over $1 trillion of long-term bonds at very, very low rates, and they locked them in. So that gives them a lot of power, dry powder to commit to capital investment. So to summarize the answer to the question, confidence is very, very important, and you can't ignore it, but it's very difficult to get your arms around. So in the meantime, I'm going to say that the needs are so strong, for energy, for agriculture, and infrastructure is going through, period. I mean, the government's going to spend and support that program. Labor substitution is so they're not just expanding capacity or just modernizing, which is more discretionary. I think many of these things are not as discretionary. Maybe that's the key word. So I'm feeling pretty confident about the capital goods market at least over the next year and a half or so.
Okay, great. Thank you. So switching to the consumer for a moment, given the high rates of inflation that we talked about, has the consumer reached a level where demand destruction is real, where maybe some of the lower income consumers are struggling with a choice between gas and milk? And if so, how do you expect that to impact consumer spending?
Yes, there's no question, and of course it's always regrettable, that higher oil prices, higher food prices has a disproportionate effect, negative effect on lower income groups. So, they're definitely disadvantaged by this, and it's got to impact their spending. In most cases, I don't mean to generalize, but in most cases, job security is less lower income families. They don't have the same high level of job security, so that exacerbates the situation. So that's clearly a negative area. However, beyond that, you certainly would expect to see some impact of high energy, high food prices throughout the consumer, the entire consumer, the full scope of consumer spending. But it's likely to be less than you might think. Let me give you a number. If you look at, I'm just going to do energy now. Energy spending as a share of disposable income. So that includes gasoline, heating oil, natural gas, electricity, et cetera. Back in 1980, when oil prices first spiked, that was about 10%. So 10% of income, disposable income, went to energy. The number today is 4.5%. Now it got as low as 3.5 or 3, but before this energy surge, but now at 4.5%, I think that's a manageable number. It's not that it's going to have no impact, but I think the impact is likely to be modest. What do I mean by modest? Maybe it shaves 0.5% off of consumer spending, real consumer spending, at the most, maybe 1%. But don't forget, you still have, as Bob mentioned, we still have that reservoir of savings, excess savings on consumer balance sheets that's coming down, to be sure. Consumers are definitely using those resources to support spending, but it's still at a pretty high level. It peaked at about 2.5 trillion. Maybe now it's down to 1.5, 2 trillion, but it's still a pretty sizable number.
Okay, great. Thank you. Overall, how would any proposed tax increase impact anything we've discussed today, whether it be corporations or at the individual consumer level?
It would be a disaster. It would not be, confidence is already low. We talked about the constraints on consumer spending, so higher taxes. I really doubt that's going to happen for one reason, and I know this is not the question, but I have to put in my point of view. It's not going to happen, obviously, between now and the midterms. And then once the midterms are behind us, we know there's a very high probability that the Republicans are going to control the House, probably by a sizable margin. I'm not a political analyst, but I just, I look at what the experts are saying. So under those circumstances, and we don't know about the Senate, it's very, very close in the Senate, but even under that divided government, I doubt very seriously that we would see any kind of tax increases. But the bottom line is that it would not be a positive for the economy. I don't think it single-handedly. Let me kind of massage that a little bit in terms of what I'm thinking. It wouldn't thrust the economy into a recession, but it would certainly weaken the growth rate. So that would be my take on that.
Okay, great. So one final question. I know we had talked about the market potentially being in a bottoming process currently. What will it take for that to kind of actually come true and for the market to rebound again, to kind of achieve your stated covering majority of the losses before the end of the year?
Yep. Well, let's talk about the bottoming first, and then we can talk about the bounce that could occur after that. Bottoming, if you study all previous markets, bear markets, and you study what happens during the course of a bear market, I'll make a couple of points. The first point is that the bottom is almost never a single point in time. It's not a single day. Bottoms occur over a period of weeks, it's like days, weeks, even months. So I would say we are in a bottoming process right now. When did it start? Maybe it started 3 or 4 weeks ago. So that's the first point I would make. Second point is what you look for at a bottom is sentiment that has really, really turned negative. This isn't very helpful to say this because you don't know until after the fact. But if the market bottoms in the next month or so that I expect, number of weeks, and we look back we're in September, October, we look back and say, yeah, that looks like the bottom. It occurs at the point of maximum bearishness, maximum fear. Well, so the question is trying to predict that. Are we there yet? Are we at a position of maximum fear? And I would say the answer is not quite. I think we're very close. And I think I mentioned earlier, one of the indicators I look at very closely is the put to call ratio. And that almost invariably signals a bottom in the market. And that's been at elevated levels now, comfortably over 1 for a number of days and weeks. The second thing you look for is the composition of selling, what's going down. And it's always the case that, I think I may have said this earlier, that investors at the very bottom of the market, investors cave in and sell those stocks that they vowed they would never sell, their cherished favorites. And those are the best companies. And we're seeing that now, as Bob observed, and I mentioned in my analysis, that we're seeing the great companies of the world come down pretty hard in the last several weeks or so. So that's a good sign. Have we seen an absolute flush? I think we have another one to go. I think we have another few really down days to go. And the reason I say that is if you go back to May of 2020, when the market bottomed on, March 23rd of 2020. For those of you who remember, who were active in the market, you'll know what I'm talking about. It was staggering to see the decline in some stocks, how rapidly they came down. Automatic data fell like 50 points in a couple of day period. Cisco Food Service, which is a great company, they fell from like 80 to 40. I mean, it was unbelievable. But before people, and what that tells, and I can give you other examples of stocks that go. Home Depot came down really, really hard. Stryker came down really, really hard. What that tells you is that investors are saying, finally, I just don't want to be in stocks. I mean, I was happy previously being in the creme de la creme stocks, but my mind has changed. I just don't want to be in any stocks at all. So they call their broker and they say, just get me out. And the fund manager calls his trader and says, put me in cash. We're almost there, which is the good news. I think we may have a little bit more to go. But we'll have to wait and see.
Brian, let me, are the questions from our audience completed, Brian?
That was the last question that we have at the moment.
So let me try and summarize and ask Bob one critical question at the end of my summary. We all as investors know what we're going through right now. This reset is painful. And those of us that have been investors for a long time, Bob, myself, Ralph, others on the call, and others in our audience today, know that these kinds of bear markets are painful. Even despite the fact that we had a strong 2019, 2020, 2021, as our colleague, partner Bruce Siegel would say, the hurt of losing is much worse than the feeling of euphoria with gaining. But it sounds like from Bob, we're in the 8th inning. We've got strong consumer and business balance sheets, which is great to know as we look forward, and we should all be looking forward. America produces innovative companies, and Bob mentioned Microsoft and Amazon and Google, all three of those companies have a cloud business that they didn't have 10 or 15 years ago that's growing phenomenally and providing a lot of earnings growth and revenue growth. The infrastructure bill that was a bipartisan effort, which is rare in Washington, we'll only start to see the benefit of that $1 trillion in the next 2 years. So that's something favorable and positive to look forward to in terms of economic growth. And one of the points that Bob has made several times this morning is that really great companies have been discounted with the bad. Maybe not quite as much. They're not down 70 or 80% like some of the companies that Bob mentioned. But when you look at the likes of Microsoft and Amazon and Danaher and even Meta, I think companies down 30, 40% or more that are solidly profitable and continuing to grow their earnings. We have the opportunity to continue to own and perhaps to buy more of these great companies. And then one last point before I ask Bob the $64 question, and that is he pointed out that sentiment is terrible, as evidenced by the put-call ratio, or any measure of investor sentiment is terrible. And normally people like me and Bob and Ralph and others view that favorably. So here's my $64 question to Bob. Would you be investing money today, looking out at least a year?
Oh, absolutely. That's an easy one, Bob.
Okay.
In fact, I am.
Okay.
and pretty aggressively, because for a number of reasons, but for the most important reason, believe it or not, is because you don't get many opportunities to buy the best companies in the world. I mean, these opportunities come along every several years. Now, I understand we had an opportunity 2 years ago when COVID hit, but it's really maybe every 5 years you get an opportunity to buy, let's say, a Microsoft that was selling at 35 times earnings, to buy it at 25 times earnings. And some of the others that we talked about, 30, 35 times, and some of them are down to 20 times earnings. So it's a great opportunity, and I am making almost every day selectively adding to these great companies. One of the questions you might ask is, well, how does this happen? Why do people sell these companies at the end? And one of the things that Bob may have mentioned, but I'll bring it up again, is that there's been so much indiscriminate selling. People just selling, and they're really not paying attention to, they're not differentiating among the companies that they're selling. So that always gives you an opportunity. The other thing that makes me optimistic is I'm always been a value guy, looking at valuation very carefully. Again, valuations have gone on the S&P from 21.5 at the peak down to 16. That's a 25% decline in the PE ratio. And that's still higher than if you look at another index, which is the S&P 500, which is unweighted. So it treats all stocks equally. So the mega cap influence is less. The PE is down to 14 times earnings for the companies. In other words, the median, if you look at it that way, the median PE is 14. I have a rule, which I think I've discussed with Bob and Ralph and others, which I call DeLucia's rule, which is how to best measure the PE ratio. And the thing I found over the years is it's the rule of 21. It's the 10-year bond yield. I'm sorry, it's the PE ratio minus the 10-year bond yield. So 21, let's say bonds are, let's say they're 3.5. They're not quite, but 3.5. So that would give you a number of what, 17.5, if I did the math right. Now, again, there are lots of things that go into it, but I think everybody would agree the most important and the most quantifiable are bond yields. I mean, for example, just to give you some flavor for this, if you go back over the last 40 years or so, the PE ratio averaged about 16. Well, guess what? The 10-year bond yield averaged about 5, 16 plus 5. When inflation, interest rates got to 15% back in 1980, 81, 82, the PE was 6 or 7. Again, 14 plus 7, 21. So that's a good measure. Is it a guarantee? No, of course not. You're talking about emotions and people's emotions and a lot of intangibles. But if I see the PE at 16 like it is today, and the bond yield's at 3.5 or less than 3.5, that tells me we're in, pretty good undervalued territory.
Great.
So
Bob.
yes, Bob, I am a buyer.
And, listen, these are tough times. And, we know from people like Warren Buffett, you buy when people are fearful and you sell when people are greedy. This is a time when many people are fearful. And you mentioned crypto and Bitcoin, and there's a lot of leverage in that area, and that's being washed out now too. So there's a lot of stuff going on that is causing some of the better companies to be discounted or thrown out in the bathwater. And that's our job as the investment advisor, the wealth manager to many of those on the call today, to pick those companies that are most opportunistic, that have the growth potential, the dividend growth potential, and we often talk about that. And we really believe that a year from today, we're going to be very happy, one, that we didn't sell today, and two, if we have some dry powder, we start to prudently put that dry powder out in the best companies in America and the world as we have this opportunity. Bob, yeah.
Could I raise one more quick
Sure.
point? I think it's terribly important. Another thing that I tend to look at, and it's worked over the years, is insider buying and selling. Really important and it's a great indicator. It's a better indicator than corporate buybacks because it's not the money of the executives or the directors that are going into the market. Now, it just so happens that buybacks are really going through the roof right now, but I'm not as impressed with that as I am with insider buying. Insider buying has taken off in the last 3 or 4 weeks or so. And that's huge. I mean, there are a lot of reasons why executives and directors sell their stock. There's only one reason why they buy their stock, and that's they think it's really attractive. And because they know their company's better than anyone, and it's their own money they're putting up, I think that it's a great indicator, and that's in positive territory right now.
Yeah, Bob, we do look at that also as we go through the portfolios that we manage. We've noticed with a number of companies, I'll mention one, Schwab, as an example. The CEO has bought millions of dollars worth of the company's stock within the past month and a half or so, at a higher price than where it is today. So we do watch that carefully, as you do, and you're right that there's only one indication when you're buying your own stock. It's because you believe that it has a very good future.
Yeah.
Listen, we've gone well beyond the time that we normally do, but given the pain that we're all going through, we thought it would be great to have Bob bring his perspective and the fact that he's been so highly respected by us and others and been pretty right most of the time, if not almost all of the time. We thought it would be really helpful to our clients and centers of influence that are on this call to have the benefit of your wisdom and what you're actually doing right now. So I thank you very much on behalf of First Long Island. You've been a great colleague and ally to us for many, many years, and we hope that continues in the future. And we thank all of our clients on the phone for their patience and their confidence during this very difficult period of time. But as you said, we're in the 8th inning, and we believe that as well. So we wish everybody a great summer. If you have any questions, please give us a call. I believe, Brian, we're recording this event today, so that it will be available to those of our clients and friends who were not able to be with us today, and we'll be posting it to our website eventually. So thank you all very much. And Bob, again, thank you so much.
Truly a pleasure, Bob. Thank you.
Thank you. Have a great day, everyone.